Imagine waking up one morning and your coffee costs $47. Not because coffee got expensive, because the money you're paying with got cheap. Now, most people hear something like that and think hyperinflation, banana republic. That can't happen here. But here's the thing nobody tells you. Here used to mean something specific. Here meant the United States. And the reason it felt safe wasn't luck. It was a deal. A very specific, very fragile deal that the entire world agreed to and has been quietly renegotiating for the last 20 years. This is the story of that deal and what happens the day it finally breaks. Let's go back to 1944. World War II is almost over and 44 countries send their representatives to a hotel in Bretton Woods, New Hampshire. The world economy is in ruins. Nobody trusts anybody's currency, so they make a decision. Every currency gets pegged to the US dollar, and the dollar gets pegged to gold. 1 ounce of gold, $35. Fixed, guaranteed. The logic was simple. America had most of the world's gold. America had the strongest economy. So if your currency was backed by dollars and dollars were backed by gold, then your currency was effectively backed by reality. That system collapsed in 1971 when Nixon ended dollar-to-gold convertibility. But here's the twist. The dollar didn't lose its status. It got stronger. Because by then, oil had entered the picture. In 1973, the United States and Saudi Arabia struck a deal. Saudi Arabia would sell oil exclusively in US dollars. In exchange, America would provide military protection and buy Saudi debt. The other OPEC nations followed. Suddenly, every country on Earth that needed oil, which was every country on Earth, needed dollars first. The petrodollar was born, and the dollar didn't need gold anymore. It had something better. It had necessity. Here's how the system actually works and why it's been so extraordinarily good for America. When Japan wants to buy oil from Saudi Arabia, it doesn't pay in yen, it pays in dollars. So Japan has to earn dollars first by selling goods to American consumers or by holding dollar-denominated assets. This creates permanent global demand for the dollar, regardless of what the Federal Reserve is doing, regardless of America's trade deficit, regardless of how much debt the U.S. government is running up. That permanent demand is what economists call reserve currency status. About 60% of global foreign exchange reserves are held in dollars. Roughly half of all international trade is invoiced in dollars, and almost 90% of all foreign exchange transactions involve the dollar on at least one side. What this means in practice, America can print money to pay its debts, and the world absorbs it. America can run a trade deficit for 50 consecutive years and nobody pulls the plug. America can borrow at lower interest rates than any other country because everyone wants to hold its bonds. This is what French Finance Minister Valéry Giscard d'Estaing called America's exorbitant privilege back in the 1960s. He was not being complimentary. He was describing a system where one country writes the rules and everyone else plays by them. Now, here's where it gets uncomfortable. The system works as long as the world believes in it. Trust is the only asset backing the dollar now. Not gold, not oil, not exclusively. Trust. And trust, once you start looking closely, is showing cracks. In 2022, after Russia invaded Ukraine, the United States and its allies did something that had never been done before at this scale. They froze approximately $300 billion in Russian central bank reserves, assets that Russia legally owned, held in Western financial institutions, were simply made inaccessible overnight. Now, from a Western policy perspective, you can argue that was justified. But from the perspective of every other central bank watching that happen, China, India, Saudi Arabia, Brazil, the message was impossible to ignore. The message was, those dollars you're holding, they're ours until we decide they're yours. That's not a reserve currency. That's a hostage. The response has been slow, but it's been real. China and Russia began settling energy trades in yuan and rubles. Saudi Arabia started accepting yuan for oil sales to China, a direct crack in the petrodollar architecture. Brazil and China signed a deal to conduct bilateral trade in their own currencies. India is buying Russian oil in rupees and dirhams. The BRICS bloc, Brazil, Russia, India, China, South Africa, now expanded to include several Gulf states and others, has been openly discussing an alternative trade settlement system that doesn't route through the dollar. The IMF noted that the dollar's share of global reserves fell from around 70% in 2000 to roughly 58% today. That's 12 percentage points in 20 years. Quiet. Steady. Easy to miss if you're not looking. None of this means the dollar collapses tomorrow. What it means is that the system is being stress-tested, and the tests are getting more frequent. So what actually happens if the world stops needing dollars the way it once did? Let's be precise. We're not talking about the dollar becoming worthless. We're talking about the dollar losing its special position, its unearned structural advantage that comes from being the world's default currency. If that happens, here's the chain of events. Foreign central banks gradually diversify out of dollar reserves. Foreign treasury bonds weaken. To attract buyers, the U.S. has to offer higher interest rates on its debt. Higher interest rates mean the U.S. government has to spend more just to service what it already owes. America's debt is currently over $33 trillion. Even a 1 percentage point increase in average interest rates means hundreds of billions more per year in interest payments, money that isn't being spent on roads, healthcare, defense, or anything else. Simultaneously, if the dollar weakens relative to other currencies, imports get more expensive. Americans pay more for electronics, clothing, food, raw materials. Inflation doesn't come from one dramatic moment, it seeps in through the cost of everything. And here's the part that doesn't make headlines. The countries that would suffer most in a dollar transition aren't the ones you'd expect. It's the smaller emerging market economies that borrowed in dollars, sell commodities priced in dollars, and have no cushion when exchange rates shift. A weaker dollar system doesn't automatically mean a fairer world. It means a different set of vulnerabilities for a different set of countries. There's a phrase used in financial circles. The dollar is the cleanest dirty shirt in the laundry. Meaning, yes, America has problems. Yes, the deficit is real, the debt is real, the political dysfunction is real. But look at the alternatives. The euro has 17 governments arguing about monetary policy. The yuan is controlled by a state that doesn't allow free capital flows. Gold is inert. Crypto doesn't scale. There is no obvious replacement waiting in the wings. Which is exactly why this process won't be a single event. No press conference, no dramatic announcement, no day zero moment where the dollar just stops. It'll be a slow erosion. A few more bilateral deals settled in local currencies. A few more central banks trimming their dollar exposure, a few more commodity contracts written in something other than USD. Death by 1,000 small decisions, each one rational in isolation, collectively reshaping something that has defined the global economy for 80 years. The dollar probably survives, but the privilege, that might already be leaving. Here's the question worth sitting with. If America's ability to borrow cheaply, spend beyond its means, and export inflation was always built on the world's consent, not on American strength alone, then what happens to the American standard of living the day that consent starts to quietly withdraw? Not with a war, not with a crisis, just with a series of unremarkable decisions made in Beijing and Saudi Arabia and New Delhi by people who have done the math and decided they'd rather not need permission from Washington to buy their own oil. The dollar may not fall, but the world it was built on already looks different than it did 10 years ago. And 10 years from now, it'll look different again.